Building owners are often faced with the challenge of deciding whether to keep their building or sell it, pay their income taxes, and then invest the after-tax sale proceeds in another property or another type of investment opportunity, hopefully at a higher return. To answer this question, we carry out hold versus sell cash flow analysis. Hold versus sell is a very special form of real estate investment analysis. With typical real estate investment analysis, we consider buying a building, perhaps arranging financing, projecting out the income and expenses over a certain time period. I typically like to use either 5 years or 10 years. And then at the end of the 10th year, we would sell the building and decide whether it's a good investment or not. In contrast, hold versus sell analysis, the investment was made a number of years ago. Perhaps we purchased the building 7 years ago and arranged financing at that time. Building owners are often faced with the challenge of deciding whether to keep their building or sell it, pay their income taxes, and then invest the after-tax sale proceeds in another property or another type of investment opportunity, hopefully at a higher return. To answer this question, we carry out hold versus sell cash flow analysis. Versus sell analysis, there's no investment being made, but there's ongoing depreciation claims that are being generated from past investments, and these depreciation claims reduce taxable income. Because of this, hold versus sell analysis should always be carried out after tax. Analysis, the financing was arranged a number of years ago when the building was purchased. What is relevant today is the current ongoing principal and interest payments so we can develop the before and after tax cash flows. I'm now going to give you a quick tour of hold versus sell analysis, and we'll be using the hold versus sell template, which is available in Investor Pro. The first thing I'm going to do is open up Investor Pro. This displays the Investor Pro panel, and I'm just going to scroll down here to the hold versus sell, and we have several choices. You can do yearly projections, which works fine for rental apartment buildings, but once we go to commercial buildings where we have leases changing during the year, tenants moving in and out, we would probably want to do a monthly projection. In addition, if you have a single tenancy, you can just choose a hold versus sell. In this case, it's industrial monthly. Or if you have multiple tenancies, you would choose a template with a rent roll, which will project out on a monthly basis. For illustration purposes, I'm going to go to Invested Examples, and I'm going to choose the hold versus sell monthly example. In the Investment tab, we enter in the original value of land. In this case, the building was purchased 7 years ago, and the purchase price allocated to the land was $700,000, and this is identified as exist. Then we have to set up the undepreciated balance of the improvements that were purchased 7 years ago, and this is done through setting up the existing depreciation. The value of the asset when it was acquired was $2,800,000. It was 7 years ago, and if we hit the compute button, it calculates the current book value and sets up the remaining depreciation claims. In year 3, January, we're going to replace the roof for $200,000. It's going to be depreciated using commercial property straight line, and it's identified as a new investment. So that sets up the information we need to set up the depreciation schedules. We also have to figure out if we sold the property today, how much would the after-tax sale proceeds be. I click on Sell Now Inputs. The sale price today is $4,200,000. We pay off the outstanding balance of the mortgage, $2,623,720. We calculate that we're going to pay $500,000 of capital gain and recaptured depreciation. The real estate commission will be 4.5%, and the legal expenses 1.50. And that completes the entries on the investment tab. And we now move to the replacement reserve tab. The current balance in the replacement reserve account is $270,000, and that's being invested at an interest rate of 2.5% per year. We'll now move to the expenses, and we project the expenses. I've kept it very simple for this example. You can have many expenses. I've simply set up one line for taxes, insurance, and maintenance. And anything that's grayed out is a projection, and that was entered in Projection Wizard. It was being paid monthly for 12 months. It's going to go up compounding. We have different methods of increasing the projections over time. Then we put in the entry. There's the start date. It's going to be for 11 years, and it's going to go up at 3% compounding. If we want to check what we entered, we hit Projection Description button. It's $8 per unit of total rentable area per year, paid monthly for 12 months, then going up at 3% compounding per year for the next 10 years. Projection Wizard enables you to very quickly enter and project out expenses and revenues, and even enter really complex lease arrangements. We then project out the revenues over the 10-year period. This is a single tenancy building, so we've got a base rent. If I click on Projection Description, I can see what that lease looks like. It's $20 per square foot, paid monthly for 12 months. Then it's going to go up at 3% compounding for the next 10 years. There's no free rent involved, but we have the recoverable expenses. Those are the expenses that are being paid by the tenant back to the landlord based on the terms in the lease. In this particular case, I haven't put in any vacancies. And now we move to the Finance tab. In the Finance tab, we set up the mortgages using the Add Mortgage button. In this particular case, the mortgage is set up, so I'm just going to edit the mortgage. Something that is really important because it's unique to hold versus sell analysis is that I identified the mortgage as already existing. I put in the outstanding balance at the start of the analysis date. The remaining amortization is 18 years at 7.5%. So I've now set up the original mortgage that was generated when the building was purchased by using the outstanding balance today and the remaining amortization period and the interest rate. Now we've set up the information when we sell the building at the end of 10 years. I'll have a real estate fee of 5%. We have some closing cost. And then we use Sale Price Wizard to determine the value. And we can base the value on a cap rate in the year of sale, or the more typical way to do it is to use the net operating income in the year following the sale. And that's the method I've chosen. There are many other ways we can set up the sale price, but the most common one is to use a cap rate based on the net operating income in the year following sale. Well, that completes all the entries. Now let's explore and take a look at some of the key hold versus sell reports. To view reports, we go to the Reports menu, and there's a very large selection of reports. You can export out to Excel multiple reports, same thing with PDF. I'd like to point out that you can also compare up to 4 analyses side by side using the Project Comparison Report. I'm just going to focus on a few of the critical reports related to hold versus sell. The most important one is the net cash flow, hold versus sell, and we need to look at that after tax. The net cash flow hold versus sell after tax gives us the big picture, and tells us whether we should hold or sell the property. Notice that there's no investment and there's also no borrowing because the investment and the financing were done in the past. In this case, it happened to be 7 years ago. However, we did spend $200,000 replacing the roof, and we funded that from the maintenance reserve account. At the end of the analysis period, which is 10 years, we pay back the mortgage. We have the operating cash flow after tax, sale proceeds after tax, and the net cash flow related to holding. If we sell the building today and pay off the real estate fees, closing cost, capital gain, and recapture depreciation, we would net $824,280. We take the cash flow from hold and subtract the cash flow from the sale proceeds to give us the hold versus sell net cash flow. The internal rate of return is 14.509 after tax if we hold compared to selling. We were looking for a desired return of 8.45%, and since the net present value is positive, we should consider holding the property. And in fact, down the bottom it gives you the conclusion. Consider holding because the net present value at 8.45% is positive. That's the essence of hold versus sell analysis. There's many reports, but I'd like to show you a really interesting graph, which is the hold versus sell net present value after tax. This graph shows the net present value for the hold and the net present value for the sell and plots it against the investor's desired return or the internal rate of return. If we took our after-tax proceeds and could invest them in another opportunity with similar risk, then we would be better off holding the property. On the other hand, if we could take those after-tax sale proceeds and invest them at, say, 17%, we would be better off selling the property. I hope that gives you a broad overview of hold versus sell analysis. If you would like to open up the practice example, you open up Investor Pro, go to the examples and open up the hold versus sell analysis monthly, and you can explore all the screens. And I only showed you two reports, the net cash flow after tax and the hold versus sell crossover report. You might want to explore and look at all the reports, including the project comparison reports. If you go to our online learning center, you can print out the hold versus sell example, which will give you all the information that was entered and will show you the step-by-step instructions on how to enter the hold versus sell project. Also, we have videos and matching manuals. The video hold versus sell is much more extensive and has an educational focus than the one you just viewed, and it also comes with a manual that you can follow along as a reference point. We offer on a regular basis a series of webinars on commercial real estate and investment analysis called Raising Your Commercial IQ. There are 5 separate webinars and each one comes with a comprehensive manual. Please visit our website for more information and the latest schedule. Thanks for watching the introductory video on hold versus sell. A more extensive educational video is also available up on the Online Learning Center together with a comprehensive manual. To the best of my knowledge, Invested is the only real estate analysis software that offers hold versus sell analysis. It can be used by investors to make wise financial choices, by realtors to help put deals together, and by appraisers for valuing properties and to expand their services by offering consulting services using hold versus sell. Please give me a call if you would like to set up a personal tutorial.